This is the Asia Trade. I'm Paul Allen in Sydney. The top stories this hour. President Trump warns the US economy faces a transition period as its focus on tariffs cause market turmoil. He also declines to predict if the US will slide into a recession this year. Former Bank of Canada and Bank of England Governor Mark Carney wins the race to become Canada's next Prime Minister. And China's February inflation declines below zero for the first time in a year, highlighting Beijing's challenge to boost consumption. All right, plenty going on in markets this week. Well, at the end of last week, we saw US stocks close higher, but the US was in fact the world's worst performing market last week amid all the trades and tariff upheaval. And it was only a month ago that we had the S&P at record highs. Futures showing us setting up for another week open in the US later on. NASDAQ futures off by almost 1%. Take a look at bond futures as well. We've really got traders piling into short-dated treasuries. The two-year yield was down pretty sharply. We see 10-year bond futures there pointing upwards, though, by a third of 1%. But the yield curve's been steepening overall. We've got the market now betting on 3 rate cuts this year from the Fed as concerns about growth now increase. TD Securities had some rather colourful language on this, saying sentiment shifted from exuberance about growth to despair. President Trump, meanwhile, saying the economy is in a period of transition. Take a look at oil prices as well, holding above $70 per barrel as production increases. It'll be interesting to watch that. Nikkei futures sitting up for a little bit of softness ahead of the open there. We still have a strong yen, relatively speaking, or is it a weak dollar? We've got the Bloomberg dollar spot index now at its lowest since early November, so the yen hovering around 147 there. The Aussie also showing a little bit of softness, 63 cents. Okay, President Trump says the US economy does face a period of transition, as I mentioned, deflecting concerns about the risks of a US slowdown. Trump's administration is arguing that tax cuts and tariff revenue will spur the economy, despite market turmoil caused by the policies. Meanwhile, US Commerce Secretary Howard Lutnick expects a 25% tariff on steel and aluminium products or imports to take effect on Wednesday as planned. We'll see. Former Bank of Canada and Bank of England Governor Mark Carney, meanwhile, has won the race to become Canada's next Prime Minister. He says retaliatory levies against the US are going to stay in place until Trump drops his tariffs. Bloomberg's Ottawa Bureau Chief Laura Kane joins us now. So, the realisation of a long-held dream there for Mark Carney, Laura. Now he's setting up for an election down the track. Can he win?
Well, it's gotten a lot closer since he got involved, I'll tell you that. For months, Justin Trudeau was really lagging in the polls behind Conservative leader Pierre Poilievre. Now, with Justin Trudeau's decision to resign in January and open up this Liberal leadership race that Carney has now won, and with Trump's threats coming for the U.S., those polls have significantly narrowed. So now that Carney has realized his ambition to win this leadership race and to become the next Prime Minister, he will be sworn in the coming days, he has a decision to make. Should he call an election now, right at this moment that the polls seem very close, but then plunge Canada into a situation where we have a caretaker government amid a massive trade war with our biggest trading partner? Or should he face Parliament and try to get some support from opposition parties? So that's going to be what he has to think about over the next couple weeks. But we do expect that he may be leaning toward calling an election soon. And as I said, the Conservatives still have a lead in the polls, but it is a lot closer now that Mark Carney has gotten involved. And some polls even have him neck and neck with the Conservative leader, Pierre Poilievre.
Yeah, Pierre Poilievre made a lot of hay out of criticising the former Prime Minister, Justin Trudeau. What sort of attack lines is he likely to put together against Mark Carney?
Well, he has started calling him sneaky Mark Carney. And the reason for that is that he's really taken aim at Mark Carney's history as a businessman. He's a former Goldman Sachs banker. More recently, he was chair of Brookfield Asset Management, which is a major investment firm in Canada. And Pierre Poilievre has called on him to proactively disclose his financial holdings rather than go through the months-long process that's required once you become prime minister. So Pierre Poilievre has tried to paint Mark Carney as someone who is secretly perhaps holding financial assets that could be conflicts of interest for him, and even, potentially be points of leverage that he says Donald Trump might have over him. Now, we don't know if that's the case, and Mark Carney has said he would put his assets in a blind trust, but that is certainly how Pierre Poilievre is going about trying to paint Mark Carney as sort of an elitist, out of touch, and potentially, someone who's hiding something from the Canadian people.
Well, dealing with US trade policy is obviously going to be a major feature of the election. What are both parties saying about that at the moment?
Well, there is broad agreement in Canada that we have to fight back and fight back hard. So both leaders, the Conservative leader and Mark Carney, have said they would keep Canada's retaliatory tariffs in place until the U.S. drops theirs. Mark Carney has also talked a lot about trying to diversify Canada's trading partners, saying that the relationship is irreparably changed, that we can no longer trust the U.S., and today saying, I will find, new trading partners and strengthen those that we already have with other countries. I will also reduce internal trade barriers to try to strengthen Canada's economy. There's really been a huge shift in Canada away from thinking of the U.S. as its greatest ally and trading partner, as to potentially even an adversary at this particular moment. And Canadians, including Mark Carney in his speech tonight, are taking Donald Trump's sovereignty threats very seriously. Donald Trump has repeatedly said he'd like to make Canada the 51st state. Justin Trudeau said last week that that is a serious threat. So Canadians are taking that very seriously, and Mark Carney saying very clearly tonight Canada will never be part of the United States and that we will forge our own economic future.
Do we know when the election is going to be held yet?
No. So as I said, he could decide to call the election as soon as next week. Another option is to wait just a week after that. Parliament will resume, and so he could face the opposition parties at that point, and they could decide to bring down the government. His Liberal Party doesn't have a majority of seats in Parliament, so it's in a pretty dicey situation if he tries to hang on a little longer in Parliament. So if he does call an election next week, as is starting to be expected in Canada, Canadians would go to the polls in late April. So, it could all be happening very quickly here for Mark Carney, sworn in as the new prime minister sometime this week, potentially calling an election next week, and then we'll see whether Canadians choose him or the Conservative leader to be their leader in the long term as they face this tariff threat from the U.S.
All right, Bloomberg's Ottawa Bureau Chief Laura Kane there. Thanks for joining us. China's consumer inflation has fallen below zero for the first time in 13 months, a sign the economy still faces deflationary pressures. Bloomberg's China correspondent Min Min Lo joins us now from Beijing. Min Min, we've got inflation slipping below zero. This is backward-looking data, however. Some seasonal factors perhaps involved here as well. How serious, how entrenched is this problem?
Yes, the inflation numbers didn't look good in February. It had missed estimates on both the CPI and the PPI. Consumer price index had fallen by 0.7% versus a 0.5% increase the previous month. And you break down the consumer prices, you look at services, you look at consumer goods, everything is down. New energy vehicles down 6%, food prices down 3.3%, a big drag on that index. But even if you strip away the volatile food and energy prices, core inflation also contracted by 0.1%. That's only the second time that has contracted in about 15 years. And you look at the producers' price index down about 2.2% versus 2.3% the previous month, is the 29th consecutive month of decline in producers' price index, signaling that demand and supply mismatch continuing on, and this weak consumer sentiment as well. You combine that with the trade data last week, imports falling by 8%. It really shows how important it is for the government to focus on boosting domestic demand this year. You mentioned the seasonal factors. Lunar New Year last year fell entirely in February. This year it fell between January and February, so there was a high base to work off. But even if you strip away the seasonal impact, China's Bureau of Statistics mentioned the inflation would have been at 0.1%. So overall, still hovering at that very low level, not much improvement in the overall trend over the past couple of years.
And of course, all this happening in the environment of tariffs, increasingly febrile trade war as well. China's now announced retaliatory tariffs on Canada. What more do we know, and what's the potential of more to come here?
So China has imposed 100% tariffs on Canadian rapeseed oil, rapeseed meal and pea products, 25% on pork and certain seafood products. And this is in retaliation for Canada imposing these 100% tariffs on Chinese EVs and 25% on Chinese aluminium and steel. At that time, China had then launched this probe into rapeseed oil. I think there are a couple of points that are interesting. One is the timing of it, coming about 6 months after Canada had imposed those tariffs and coming at a time when that trade war is heating up and Canada is under pressure from the US to match US tariffs on China in order to avoid those tariffs that Trump has threatened to impose on Canada. Plus, also coming as Canada is prepared to review that North American free trade agreement with Trump as well. The second thing that's interesting is the scale of these tariffs, 100% and 25%, pretty much matching what Canada has imposed on China, and in stark contrast to how China has retaliated against the US, which is less than proportionate. So it's signaling here that there is room for dialogue with the US, but maybe not so much for Canada. It's almost like a warning shot to Canada not to impose further tariffs in China amid this escalating trade war.
All right, Bloomberg's China correspondent Min Lo there. Let's get to some other stories that we're following. President Trump says he still expects his Ukrainian counterpart Volodymyr Zelenskiy to strike a minerals deal with the US. Speaking with Fox News, he again accused Zelenskiy of being ungrateful for US support. Officials from both countries are meeting in Saudi Arabia this week to resume talks for a possible ceasefire between Russia and Ukraine. A US negotiator says a new Gaza ceasefire deal is possible within weeks. Adam Boulder told CNN the possible agreement could even see Israel recover all hostages held by Hamas. A 6-week truce expired earlier this month. Both sides still divided on conditions for more suspension of hostilities. Israel has since halted its limited supply of electricity to the Gaza Strip in response to the crisis. Elon Musk is backing the idea of the US exiting NATO. Musk, who is a senior advisor to Trump, supported a post on X which called for the US to exit the bloc, saying it doesn't make sense for America to be paying for Europe's defence. Musk's comments come as the future of NATO hangs in the balance, with NBC earlier reporting that Trump had discussed calibrating US engagement with the military alliance. The European Commission says there's no risk or no reason to de-risk the EU's relationship with the US, despite changes under the Trump administration. President Ursula von der Leyen has led a shift in the bloc's relationship with China that she has described as de-risking but not decoupling from Beijing. But she told a conference in Brussels that a similar strategy is not needed towards Washington. Let's take a look at US futures, because that's changed in the past 15 minutes. They were looking positive for a while there. We've now got S&P futures off by a little bit more than 0.75%. NASDAQ futures still off by about 1%. It's been a pretty nasty week for US stocks last week. It was the world's worst performing market, in fact, against a backdrop of all this trade and tariff upheaval. And what a change from a month ago when the S&P was at record highs. We have more ahead on the Asia trade. This is Bloomberg. China's February consumer inflation dropped below zero for the first time in 13 months. It's an assessment skewed by seasonal distortions, but also signs of deflationary pressures in the economy. Beijing is aiming to bring its consumer price growth to about 2% in 2025. That's down from the previous 3% target. Louise is the lead economist at Oxford Economics, joins us now with more on this. So, Louise, let's start with that deflationary picture in China. Yes, you could argue that there are some seasonal factors, the base effect in play here, but how serious is this problem in your view, and does it demand a greater policy response?
Hey, good morning. So when we look at the inflation picture from February, I would say that there are some worrying signs, but because of the seasonal distortions, I think policymakers will want to see further prints before they embark on an accelerated fiscal push. We think at this stage it is probably necessary because there is a very strong sign that the economy is in stuck in a deflationary loop. And I say that because if you think about the imports number in January, you think about the inflation number in February, yes, they did announce a 2% CPI target at the two sessions last week. But if you look at the numbers around the implicit GDP deflator, they're expecting it to be negative this year. So there is an acknowledgement that the economy faces huge negative price pressures. And so in order to get out of that, the only lever that they could use is potentially more fiscal stimulus.
Yes, and we've not really seen the kind of fiscal stimulus that certainly the market would like to see at this point. Do you anticipate that big bazooka could be coming in 2025, or is that just not on the table at all?
I don't think it's really on the table. Still, we are expecting a bigger fiscal push compared to last year. So that's very well reflected in the increase in the government fiscal deficit target that they announced last year. It's also quite evident in the increase in the special bonds, which they typically earmark for stimulus spending, that they have also announced last year. But we don't think it's a bazooka stimulus because of the strong language around risk containment, because of the risk aversion around increasing financial leverage. So it really is continuing to be a balancing act. This year, we think that it will be a positive fiscal impulse, so we'll see more fiscal push. But by and large, I think policies will continue to be quite reactive to event risk, reactive to tail risk, rather than really generating the kind of credit upcycle that we saw post-global financial crisis, for instance.
So there's going to be a greater focus on domestic consumption in China, but I'm wondering what your view is on the export picture as well. What's your outlook for exports for China in 2025? And against the backdrop of this trade tension with the US, what are the implications for improving relations with non-US trade partners?
Well, so last year, exports clearly was the driver to the Chinese economy. You know, in real terms, export grew by about in a double-digit, almost 15% year-on-year pace. Now, this year, from that very high starting point, we're expecting that goods exports would broadly be flat this year. So not a jump off the cliff, disastrous outcome, but pretty resilient exports. And part of that, like you said, Paul, is driven by the fact that the export outlook to the rest of the world, ex-US, continues to, we think would likely continue to be quite resilient. That's because over the last 5 or 6 years since the first trade war, China has actually been able to successfully increase its export share into these markets. So really, the direct trade impact from vis-a-vis the US trade tariffs are unlikely to be that detrimental to the Chinese economy because of the ability to really divert trade away from the US via some of these third-party economies. Now, having said that, the path of trade tariffs continue to be quite uncertain, and I think that that uncertainty will continue to weigh on business sentiment, and that would have secondary effects beyond the direct trade effects that we will see on the Chinese economy this year.
Well, we're going to get CPI numbers out of the US this week as well, which is going to be interesting in the environment of tariffs and trade tension. I'm wondering what your view is on the risk of inflation returning in the US this year.
Well, I think we've always said that trade tariffs that the US puts out are more detrimental to its own inflation than to the rest of the world. And I think inflation numbers in the coming months will slowly show that as tariffs come into play. Now, whether or not then that puts the Fed in a little bit of a tight spot, because if it wants to actually delay some of these rate cuts, then that could have implications on what it means for the global, what it means for growth, the growth outlook in the U.S. economy as well. So I think that the pass-through of tariffs onto the real economy will become more pronounced in the coming months, and because of that, we are expecting that at some point further down the year, there should be a clear path towards trade talks, at least between US and China, in order to kind of hash out some of these rather punitive measures that have come through.
Just sticking with the inflation theme here as well and jumping back to Asia as well. We're going to get numbers from India as well. We see inflation there easing. What's your view on the inflation outlook in India and how the RBI is going to react?
Yeah, so our view on inflation in India is that this coming week, we think that it will stay relatively benign at around the low 4% handle. That should support real incomes and private consumption demand, which actually have started rebounding at the end of last year. Because of that context, we don't think that that warrants another cut in the RBI meeting in April. But instead, I think policymakers over there should continue to adopt a wait-and-see approach, given the kind of ongoing uncertainty that we saw, that we continue to see in global trade policies, as well as some of the idiosyncratic domestic weather events that could actually continue to push up food prices onshore.
Do you anticipate any impact from the reduction in GST?
Well, we are penciling in a small decrease in a small downward pressure on prices in India. But overall, I think the inflation picture in India continues to be quite well managed, and that should give policymakers some room to really allow the policy to be more data dependent on the growth side of things.
All right, Louise Liu, lead economist at Oxford Economics. Thanks so much for joining us. We have more ahead on the Asia trade. This is Bloomberg.
Inflation has come down a long way from its mid-2022 peak above 7%, without a sharp increase in unemployment. While progress in reducing inflation has been broad-based, recent readings remain somewhat above our 2% objective. The path to sustainably returning inflation to our target has been bumpy, and we expect that to continue. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
There's Fed Chair Jerome Powell speaking in New York on Friday. Well, markets did react to Powell's remarks, including here in Australia. We have seen bonds. We've seen decline in Australian treasuries. Effectively, you see the yield slipping a little bit on the 3-year note. It did initially add a few points after Powell spoke, but there's a lot of uncertainty around the growth environment. Powell spoke about inflation coming under control, but increasingly trade is a little bit concerned about growth. Powell did emphasize that the U.S. economy is in a good place. Doesn't need immediate action, but we did hear from TD Securities as well, saying sentiment is shifting around exuberance about growth to despair. So we see yields starting to slip here in Australia a little bit. The Kiwi yields ticking up ever so slightly. Let's take a look at oil as well. Some big moves there. The outlook for oil seems to be towards the weak end, however. We've got Brent continuing to slide just above $70 a barrel at the moment. It did have a 60 handle last week. Production's increasing. The US is currently producing more barrels a day than any country in history. OPEC's also boosting production, perhaps to defend its market share. And we've got long oil positions now at their lowest since 2010. Got more ahead on the Asia trade. This is Bloomberg. Okay, got some breaking news out of Japan. It is labour cash earnings for the month of January. A little bit of a miss here. We've got the cash earnings rising 2.8% on year, but the expectation was for a 3.1% increase. Real cash earnings, meanwhile, actually declining 1.8% on year. That was larger than the estimated contraction of 1.5%. We still have a relatively strong yen compared to what we've seen of late, but 147.60 63. Also tells us the story of US dollar weakness. We've got the Bloomberg dollar spot index at its lowest since November. So slightly softer than expected labour cash earnings out of Japan for the month of January. Well, let's get a little bit more on Japan's wage growth. Economy and government reporter Erika Yokoyama joins us now in Tokyo. So, Erika, what are the implications here for the BOJ?
Right, so I think the headline figures look slightly weaker than expected, but still today's data would keep the BOJ on track for the further rate hike. Because what BOJ closely follows for its policy decision is the underlying trend, and that points to very positive signs. For example, the base pay rose most in 32 years, while more stable measure that excludes overtime pay and bonuses rose 3% for regular workers, hitting the 3% mark for the first time since July. So overall, these leadings points to steady progress in wage gains in Japan. As most economists expect, the BOJ may hold on another rate hike until summer after it just raised interest rate to 0.5% in January. But still, I think today's data is helpful for the BOJ to confirm that economy is in line with their projection area and keep considering the next rate hike timing.
So, Shundo, wage negotiations are also underway. What's the latest with that?
So far, it looks stronger than expected by the market area. Last week, Japan's largest labor union federation, Rengo, released the tally of workers' demand, and that exceeded 6% for the first time since 1993. Workers are putting stronger pressure on companies to keep raising their salaries. And what traders are watching closely is companies' response to these strong demands from workers, and especially Rengo will release their first tally of pay deals on Friday 14th this week. And economists are largely expecting Japanese workers to secure similarly strong wage gain to last year, and considering the tight labor market condition in Japan, which will require businesses to keep raising wages to retain and attract workers.
Let's talk about that real wages, that real cash earnings number, however, a contraction there of 1.8%. That was more than expected. Isn't that a concern for policymakers?
Indeed, that's right. I think that's the headache, especially for Prime Minister Ishida as the election approaches in the summer. And the problem is actually inflation that has been faster than the wage gains. And ruling parties still remember that public discontent over higher prices and stagnant real wage gains partly led to fall their former leader Kishida. So Ishida really needs to fix the inflation issue as soon as possible. And he already introduced a couple of price relief measures. One of these recent efforts includes the decision to release the stockpile rice to lower the price of the grain after it saw a surge. Now it's time to see whether these efforts will help and boost public sentiment and shore up Ishiba's support before the summer.
All right, economy and government reporter Erika Yokoyama there. Let's take a look at how Australian assets are tracking at the moment. It's a fairly positive start for the ASX in the early going. We did have the index hitting a 6-month low last week, although we're getting very close to breaking through that 8,000 point level again today. We do have most sectors on the index higher, and even insurers doing reasonably well. That sector better by 1.6%. I mentioned insurers because we've had a cyclone hit the east coast of Australia. Cyclone Alfred weakening now to a tropical low. Still poses a threat though, bringing high winds and flooding to northeastern areas in Australia. Prime Minister Anthony Albanese ruled out calling an election over the weekend due to the cyclone. For more, let's bring in Bloomberg Intelligence senior analyst Matt Ingram, also Australian government reporter Ben Westcott. So Matt, I'll start with you. We've got the cyclone downgraded to a low now, but it doesn't mean there's nothing to worry about, does it?
Paul, it's actually ironic. I think perhaps a low-moving coastal low in some ways is worse than a cyclone. It brings extremely heavy rain. We saw up to 800 millimetres fall in parts of southeast Queensland. That's about the annual average for Brisbane, to put it in context. Cost of floods is substantially higher than wind or fire, and so you might actually see much bigger claims, much bigger costs on the back of that slow-moving coastal low.
Yeah, let's talk a little bit about the costs and the impact on insurers. What sort of bill are we anticipating?
The 2022 floods in Brisbane were about $3 billion. Most of that won't be borne by the three big Australian insurers, QBE, Suncorp and IAG. A lot of that's going to be borne by the reinsurance market. I think something that's a bit troubling, though, is about 60% of losses are uninsured. So those are going to be borne by the homeowners, the car owners, the business owners. So a big bunch of this cost is going to be borne by the community, not by the insurance market.
All right, let's get to Ben Westcott, joins us as well from Canberra. Ben, this kind of threw a spanner in the works in terms of election timings, doesn't it? What's left in terms of available dates for the Prime Minister?
Yes, absolutely. I mean, obviously, we can never say for sure what goes on behind the walls of the Lodge, but it was widely expected that Albanese was planning to call an election for April 12th this weekend, or on Monday today. However, yes, this cyclone has basically led to Albanese ruling out any election before May. That's because April 12th, with now, having missed that, he can't hold the election on April 19th, because that is Easter, and he can't hold the election on April 26th, because that is Anzac Day. So that leaves 3 dates left for the Prime Minister. That's May 3rd, May 10th, and May 17th, and that will require him to hold a budget on March 25th as well.
In some respects, it does buy the government a little bit of time. They have been trailing in the polls, although there's some good news over the weekend. Labor enjoying a significant victory in Western Australia. Does that have any implications for a national poll?
Look, the answer is yes or no. Yes and no. I mean, it does. The fact that Labor's vote is holding up so successfully in Western Australia, which was a hugely important seat at the last election, hugely important jurisdiction. Basically, Albanese would not be in the Lodge today, at least not in majority government, without the major victory they had in Western Australia. And holding those seats is crucial to him maintaining government at this election. So this result will be positive for him and his government. It shows that the sort of red wall in Western Australia is holding. However, some of those seats that he will need to either pick up or hold at the next election, seats like Bullwinkle in the suburbs, have shown swings against Labor, and they were already considered pretty much on a knife edge. So it will be interesting to see whether or not Albanese can have the same level of popularity in Western Australia as Roger Cook, the current Premier, does. Most people seem to think that is probably not 100% likely.
You mentioned that there's going to be a budget first towards the end of the month. To what degree does this provide an opportunity for the government, particularly, as Matt was saying, the community up there in Queensland is going to have to bear some of the cost itself? Is there a chance here for some spending, perhaps win a little bit of favour among voters?
There will be some spending, I think. I think one of the downsides for the government is they had planned, they already rolled out many of their election announcements, including their big $8.5 billion into Medicare, which I think will be one of the central pillars of Anthony Albanese's re-election campaign. But something that they hadn't announced and is widely expected is further relief for households in terms of their energy bills, so another rebate to households to take a bit of pressure off energy prices. That will probably be the central pillar of the budget. Although the other thing the government is a bit worried about in terms of the budget is this does give Peter Dutton a chance to deliver his budget reply speech. That's the opposition leader can get a televised address in which he will be able to roll out some of his own policies and, again, voice his displeasure with the current government. So they are giving a major platform to the opposition leader by holding a budget, but at this point, Albanese did not really have a choice.
All right, Bloomberg's Ben Westcott there in Canberra, Matt Ingram here in Sydney. We have more ahead on the Asia trade. This is Bloomberg. we've got Japanese markets opening at the top of the next hour. We did see the yen strengthening just a little, or weakening just a little, I beg your pardon, after the labour cash earnings numbers for January. Just to recap those for you, 2.8% rise on year. That was less than the 3.1% expected, and real cash earnings actually contracted more than expected as well. But the broader trend line for the yen is stronger. That's as much a dollar weakness story as anything else. We got Nikkei futures meanwhile pointing to a positive open, currently higher by about 0.5%. All right, a shareholder in Japan, Seven & I Holdings, is now pressuring the company to engage more deeply with Couche-Tard over its $47 billion buyout approach. Artisan Partners has questioned the independence of Seven & I's special committee led by CEO Stephen Dacus and is urging the company to fully engage with Couche-Tard to maximise shareholder value. Artisan owns stakes of roughly 1% in both companies. Well, let's get some more analysis with our next guest. Seijiro Takeshita is professor at the School of Management and Informatics at the University of Shizuoka. Seijiro, thank you so much for joining us. I just want to pick up with that claim from Artisan saying that the Seven & I board has taken several decisions that leave significant unanswered questions. They're wondering whether it's got the best interests of shareholders at heart here. What's your view of this position? Is it reasonable?
Well, I'd say the redemption back to shareholder, the scheme that he has announced, the new CEO has announced, is quite generous in many sense. But the question that most of the analysts and investors here in Japan, and also the stakeholders are asking, is what happened to Seven & I? And the reason for this is redeeming back profit back to shareholders also mean that there is no growth or possible investment that could generate growth in the future. Usually in Japan, what most companies do when they do the share buyback is when they have nothing better to spend their money on. So basically, the Japanese investors tend to look at capital gains, and for that reason, the action by Seven & I, although it's very generous to investors, are seeing rather negatively or with a lot of question mark, as you connotated, because it almost gives an answer to the market saying that, hey, we have nothing else better to spend than, trying to protect ourselves from the ACT.
Oh, Seven & I seems very determined to fend off this bid from Couche-Tard. Does this approach make sense?
Well, they've always wanted to sustain their operations and, with a foothold of mainly in Japan and then expanding overseas. And certainly they don't want any new corporate culture ramming into their, methodology. They're not as, in my personal opinion, as open a company as you'd expect. But, at the same time, they have succeeded in their methodology of basically reigning, within the Japanese CVS business. So, from that point of view, I can understand that they want to barge off, anybody that's trying to basically get into their business.
You mentioned the share buyback idea. While generous does suggest there's no better ideas on the shelf, where could that money be put to work to expand the business?
Well, actually, to amalgamate, further about the CVS business in Japan, because in Japan as a whole, we have too much retailers, end of story. And also, CVS is also going through an excessive competition. And, Seven & I is doing a pretty good job within that arena. So they can strengthen that. And they also need to consolidate a lot of businesses that aren't really profitable, like that of, Ito-Yokado side. So those are the areas that they must really move fast to really consolidate their powers, because many people are suggesting that their truncation of, Ito-Yokado is far too slow.
Seijiro, I want to talk about Nissan as well, now considering 3 foreign candidates to replace Ushida-san as CEO. Now, Nissan's been down this path before, and it ended in spectacular fashion with Carlos Ghosn. What's different this time?
Well, not much so far. I think there's always a problem about management, as you just pointed out. I mean, this is a company that has, 3.3 million automobile sales compared to, let's say, Honda's, 3.8, which they tried to merge together, but with a loss of 80 billion yen. And, Honda's making a profit of like 800 billion yen. But, that said, when you look at the bonus pool of the management side, the compensation pool, Nissan has 60% more. That itself already tells you they've got a lot of problems on their governance style. And also, when you look at the fact, when I talk to a lot of, automobile parts manufacturers or trading firms that are associated, they all say the same thing, and that is that, Nissan is far too bureaucratic. And you're talking about Japan, which is already a very bureaucratic community. So you can imagine that, they've basically truncated so many things, basically stuffed so many things from just going through, just kept the bottleneck at this point. So we need somebody, who can really clear this problem, if and when they become the CEO.
Yeah, and it's not just a matter of selecting the right person. To what degree does Nissan need financial support as well? And in that respect, there have been a number of potential names floated around, some very diverse names as well, such as Foxconn, private equity, and KKR, even the Japanese government in the form of METI. Who's the best fit here, not just to lead the company, but to strip away that bureaucracy, turn things around? Is it tech, private equity, or another car maker?
I think it would have been best if another car maker like that of Honda had taken over. That would have been the best solution because, well, when we have other financials that basically gets into the management, then, the progress of sustaining technology or basically looking at technology first, which is very typical of, in fact, Honda, will be in the second priority. So what we need here is a car companies that can consolidate their powers to cope with a worldwide competition, both in volume as well as in technology side, as we are getting all these new technologies hanging around. So basically, I think it would be better if, Honda could merge with, a better player with their better management in the same arena, rather than having a totally different fund, kicking into their system.
All right, Seijiro Takeshita, professor at the School of Management and Informatics at the University of Shizuoka. Thank you so much for joining us today. And you can catch Japan Ahead every Monday, 8:40 a.m. if you're watching in Tokyo. And subscribers can watch live on the Bloomberg terminal using the TV Go function. This is Bloomberg. All right, we've got some more data out of Japan. Breaking news, it is the current account balance also for the month of January. The deficit a little bit wider than anticipated, 257.6 trillion yen, billion yen, I beg your pardon. That is, like I say, a little bit wider than anticipated. The balance of payment current account adjusted, however, that surplus coming in pretty much in line, 1,937 billion yen. Not a lot of change to the yen there, still hovering around that 147.60 mark, although, as mentioned, this is as much a story of dollar weakness as anything else. Let's take a look at how we're tracking here in Australia in terms of markets. We did have a pretty bad week for the ASX last week. It hit a 6-month low. We're seeing something of a modest recovery underway at the moment. US stocks also closed higher on Friday. So we've got the ASX better by about 0.25% there. One of the best performing assets at the moment is, in fact, insurers, better by more than 1%. That's despite Cyclone Alfred hitting northern New South Wales and Queensland pretty hard over the weekend. That's now weakened to a tropical low, but still a lot of bad weather up there, dumping a lot of water, and the flooding risk still very much alive. US, the Aussie dollar there, meanwhile, just parked above 63 cents. Well, the US casino group Bally's has reportedly made a last-minute bid to recapitalise Star Entertainment. According to the Australian, Bally's would inject a minimum of $157 million into Star. Bloomberg News business reporter Angus Whitley joins us now. Angus, $157 million, well, it's better than zero, but is it really going to be enough to turn things around for this beleaguered casino operator?
Yeah, that's a good question. Morning, Paul. I mean, this is a last-minute offer, really, when you think about it. Star is really down to the wire in terms of the amount of cash it has left to avoid collapse. And as you said, we had a lot of detail in a report in the Australian today about this proposition from Bally's. It's a $250 million cash injection, but according to the newspaper, that's in the form of convertible bonds that would convert into 50.1% of Star. So really, when you boil it down, it's Star selling control of itself for 250 million in essence. So it's a bar sale really on those kind of terms when you think of the valuation that Star had a few years ago, several $1 billion. And of course, this Bally's Corp offer, if it does transpire, is in competition to other deals that Star has struck in recent days, most notably the one that it announced on Friday, an agreement to sell out essentially of all its assets in Brisbane to its Hong Kong partners, Chow Tai Fook and Far East Consortium. And that would see essentially Star focus on Sydney and its Gold Coast casinos and surrender its half share of the Brisbane resort to its Hong Kong partners for 53 million. So Star would have to be pretty bold to really tear up that agreement. And it had two financing proposals it also announced on Friday. A bridging loan of 250 million Australian dollars, paying 15% interest. So that's a steep price to pay for cash in Star's situation. But it also has a refinancing proposal as well, almost 1 billion Australian dollars. So there's been a flurry of activity in recent days as Star approaches the last hour of its life as a viable company, if you like. And I think if Friday's deal proceeds and the bridging loan and the refinancing deal proceeds, Star really has won time. It's not out of the woods yet, but it has time now to sort of really get its house in order, prepare for an imminent fine, get its earnings back in some respectable fashion. But it's not clear it's yet going to survive in some kind of respectable fashion.
All right, Bloomberg News business reporter Angus Whitley there on Star Entertainment. Shares remain suspended. Let's take a look at the yen, still hovering around 147.63 after a mixed bag of data out of Japan. We have market opens in Seoul and Tokyo next. This is Bloomberg.
This is the Asia trade. We're counting down to Asia's major market opens, and certainly a lot for investors to the downside to be contending with as we kick off a new week. China's inflation, the CPI levels falling below zero in the first time in about a year, and lots of concerns over the US as well. Even President Trump is acknowledging that.
Yeah, that's right. A little bit of disturbance. We shall see. There's meant to be some new tariffs coming this week as well, this time on aluminium and steel. Again, we shall see. We've seen reversals in the past, so I wouldn't want to be saying any statements with any certainty right now.
Certainly not, but we have seen really kind of this continuation of the doubt over the US kind of stock exceptionalism story, right? And we are seeing all of that feeding into not a great deal of confidence as we kick off trading this week. We do have Australia, of course, already underway for about an hour, but let's get you straight to the open when it comes to Tokyo and Seoul at the moment. Japan's a really interesting story because it does look like full speed ahead when it comes to the Bank of Japan with the fastest base pay gains, I should say, in 32 years. So all of this positive signaling to the BOJ at the very least, really weighing the prospects for the revival of demand-driven economic growth domestically, despite, of course, all these ongoing difficulties when it comes to the broader economy. We are seeing the Nikkei 225 as well as the topics just advancing modestly in the first few minutes of trade. This is the picture when it comes to the yen, of course, that question mark over the dollar as well, but the yen kind of keeping that hike window certainly open, at least for now. But broadly, we are seeing that weakness as we get into the first trading session. These concerns about broader global growth, concerns over China's disinflationary, potentially even stagflationary outlook at the moment, with that inflation on a consumer level dipping below zero for the first time in a year, and certainly bond traders not feeling super confident when it comes to the US economy as well. Take a look at what's happening when it comes to Korean markets at the moment as we head into that open. Just the first couple of minutes, quite a bit of downside. The Kospi off by just about 0.2%. Tech stocks following the weakness that we've seen on Wall Street as well, off by about 0.3% there as well. We're watching some of those uncertainties when it comes to domestic domestic budget talks, as well as a political situation after the President Yoon was released of his arrest in January.
All right, let's take a look at how we're tracking here in Australia as well. We've got the ASX showing some modest positivity. It's off some of the earlier highs that we've seen, just better by 0.1%. We did have the ASX hitting a 6-month low last week, so it's still struggling to breach that 8,000 point level again. One bright spot, insurers performing quite well, better by about 1.8% today, and we have of course had a severe cyclone strike the northern east coast of Australia, and still flooding proving to be a major risk there. We also saw yields ticking up in Australia as well, following the remarks of Jay Powell. He says he's not too concerned about what's happening in the US at the moment, encouraged by the inflation picture as well, and not feeling any pressure to move on rates either. Let's take a look at oil. A bit of action happening there. We've just had Brent sink through the $70 a barrel barrier, $69.89 for a barrel of oil at the moment. Production is increasing. The US is currently producing more barrels a day than any country ever in history. OPEC Plus also boosting production, maybe with an eye on defending market share. All right, joining us now is Rupal Agarwal, Asia Quantitative Strategist at Sanford C. Bernstein. Rupal, I just want to start with your thoughts on what we've seen happen in US markets last week. The S&P a month ago was hitting records. Now, last week, the US was the worst performing market in the world. How enduring do you expect this trade to be?
Good morning. So I think, yes, when we started the year, there was this very big narrative on US exceptionalism. That, to a large extent, has been challenged. When we started the year, again, there were a lot of these uncertainties around tariffs and how Trump's policies are going to play out, because there are two aspects of, his policy agenda. One, which is incrementally going to be much more positive for US. And the second, which unfortunately where we've started off from, which is tariffs and immigration, that's not necessarily good for global growth. And that has started having its fair share of pressures on the equity markets. Plus, we have now started seeing a lot of concerns around US growth, and I think that has been one of the big concerns for US equities.
Yeah, do you have any concerns about US growth? I mean, we heard from Jay Powell and Mary Daly as well. They're in no hurry to ease. President Trump calls this a period of transition, but are you ready to utter the R word yet?
Not yet, I would say. I think we're still in potentially headed towards a stagflationary kind of environment. So growth is slowing down, inflation has been sticky, and with potential tariffs coming through, there is expectations that inflationary pressures could again start creeping up. So I would say too soon to say the R word, but definitely heading towards stagflation.
That you say in your research reports, of course, the two biggest sort of unknowns and questions for investors are what happens with India and what happens with China, right? Let me ask you about China, because I want to bring up this chart showing just the big performance gap that continues to spread between US equities and Chinese equities at this point. In fact, the MSCI China is seeing the biggest performance gap since 2007 versus the S&P 500 this quarter, outperformance by the most in 18 years. So do you expect that this, well, first of all, does this divergence continue, but does the Chinese outperformance also continue?
We do think that there is, potential for China to continue to do well. In fact, even at the beginning of the year, there were signs that China could start rebounding. At that time, it was a lot more expectations coming from policy support. Valuations were still very attractive. Earnings downgrade cycle was showing signs of an inflection. Investor sentiment was, again, showing signs of a bottom. And since then, I would say there are a couple of additional things that have happened, which are pivotal. One is, we of course saw the DeepSeek movement. The second one was more around, President Xi's meeting with a lot of these tech leaders, which in my view has been, key indicator for a lot of global investors to say that all these issues that they were concerned about China for the last few years are essentially abating. And that is where some of the global investors, at least, in my view, could actually move from that uninvestable camp to actually an investable camp. So I would say that there are tailwinds for Chinese markets to do well. Having said that, I think there are still a lot of challenges that China is dealing with, from a deflationary standpoint, from the clear impulse that all of us are expecting to come through for Chinese consumers. I think there are still lack of details there, but in the global context, China is still quite undervalued, and there are still tailwinds potentially coming from policy support that I would say would still continue to support the markets.
Yeah, so as you say, there's some sectors where the woes do continue unabated, right, like property and real estate. But does that mean you'd be focusing on the opportunities that get thrown up by this refocusing on the private sector and on tech?
Absolutely. So we've been slightly more balanced, I would say, in our approach. So on one side, the idea is to look at a lot of your tech companies, your consumer names. They are going to be more beneficial, get that tailwind from a lot of these policy support. But at the same time, I would also not completely ignore some of the defensive pockets in the market, which have been doing well for the last, say, few years, because globally, I think the macro situation is not great. Overall, for EM as a basket, we are still looking at, potentially stronger dollar. We are also still dealing with very high yields, in the US. And these are not great, macro situations for EM, as a basket. And hence, the idea is to, yes, play the China reversal story, but at the same time, still have, say, some of your China financials or some of the high-yielding names. So the idea overall for Asia is to focus a lot more on shareholder yields, because that in and of itself has also started increasing in the region.
Rupal, always great to chat with you. Rupal Agarwal there, Asia Quantitative Strategist at Sanford C. Bernstein. Let's take a look at one of the stocks that we're watching, and it is Seven & I, as we see one shareholder there, Artisan Partners, pressuring Seven & I Holdings to engage more deeply with Couche-Tard over that $47.5 billion buyout approach. We are also hearing that Joseph Michael DePinto has resigned as a director, saying Seven & I, though, at the moment saying that it's regrettable that Artisan Partners has misunderstanding its stance there. Artisan Partners have been questioning the independence of Seven & I Special Committee led by the CEO, Stephen Dacus, and is urging the company to fully engage with Couche-Tard to try and maximise shareholder value. We do know that this is a big week when it comes to these potentially ongoing negotiations. Couche-Tard executives will be visiting Tokyo this week to try and push forward these discussions. A news conference expected on March 13th to present their case for buying the company, and I guess any sort of progress that has been made. That proposition, of course, coming through last year to purchase the parent company of 7-Eleven for $18.90 US per share. But of course, that approach has been consistently fended off by Seven & I, which has looked at other alternatives, like an overhaul of the company to try and unlock that demanded shareholder value, Paul.
Let's take a look at what US Treasuries traders are having to say about their growth concerns. Well, we've got Treasuries rallying across the curve. The 5-year yield now down about 5 basis points, around about 4.083 there. We also saw the 2-year yield down pretty sharply as well towards the end of last week. So US bonds traders have been piling into these shorter dated notes. We've got the yield curve steepening and the market now betting on 3 Fed cuts this year as concerns about growth increase. President Trump, of course, says the economy is in a period of transition. Jay Powell was saying he feels no pressure to move on rates, but the bond market certainly having its say right now on the growth outlook for the US. We've got more ahead on the Asia trade. This is Bloomberg.
Well, Well, President Trump says the U.S. economy faces a period of transition, deflecting concerns about the risks of a U.S. slowdown. Trump's administration argues that tax cuts and tariff revenue will spur the economy despite market turmoil caused by these policies. Well, the former Bank of Canada and Bank of England Governor Mark Carney has won the race to become Canada's next Prime Minister. He says retaliatory levies against the U.S. will stay until Trump drops tariffs.
The Canadian government has rightly retaliated and is rightly retaliating with our own tariffs that will have maximum impact in the United States and minimum impact here in Canada. And my government will keep our tariffs on until the Americans show us respect.
Bloomberg's Derek DeCloe joins us now for more. So what do we know in terms of, was this an expected result given the leadership race, and how popular is he?
It was expected that Carney would win, but not by the margin that he won by. He pulled in 86% of the votes. His next closest rival was Chrystia Freeland, the former finance minister, who got only 8%. It was quite a blowout, and that was beyond the margin that I think most were expecting. Now, polls show that the Liberals are more popular with Carney as leader than they would have been under Justin Trudeau or any of the other alternatives. But there is a caveat to that, which is that although people in economics and central banking and so on obviously know Carney well, the Canadian public doesn't necessarily know him that well yet. And he hasn't been in government, and he was at the Bank of England for a number of years. And so we will see how it all translates when we get to a general election campaign, which is now expected pretty soon.
So, Derek, when that election gets called, what are the key themes that it's going to be fought on? And I imagine it's probably going to be an arm wrestle in many respects to see who can push back hardest against the US.
Yeah, I think the top three issues, if the election were held today, are Trump, and Trump. The trade war, the tariffs, the threats about Canadian sovereignty, Trump's sort of repeated comments about the 51st state. These have shot to the top of it's all really anybody is discussing, and of course, concern about the economy, about employment, about the potential of a possibly serious recession if it does come to a prolonged trade war, and that I think helped Carney's leadership campaign an awful lot, since he could. He'd say that he had significant economic experience, having run 2 G7 central banks.
All right, Bloomberg's Derek DeCloe in Toronto there. Well, China's consumer inflation has fallen below zero for the first time in 13 months, a sign that the economy still faces deflationary pressures. Bloomberg's China correspondent Min Lo joins us from Beijing. So, Min, maybe some seasonal factors, low base effect at play here, but what sort of response from policymakers does this demand?
Yes, the inflation data for February looking pretty bad. As you said, the seasonal factor is at play because Lunar New Year fell entirely in February last year. So that provided a high base for this February's prices, especially when it comes to food prices. That was down 3.3%, a big drag on that overall index. But even if you strip away that volatile food and energy prices, you look at core inflation, that's negative 0.1%. The first time it's in decline since 2021. You combine that with the trade data, the disappointing import data, which collapsed by about 8%, it really shows the weak domestic demand here. And trade is really closely related to domestic prices as well, because when exporters can't sell overseas, they sell to the domestic market. That just put more downward pressure on prices. You look at the PPI there, negative 2.2%, the 29th straight month of decline in prices. So of course, this is all backward-looking data. Looking forward, I think March will give us better sense of whether that inflation trend would be a little bit more reflationary given the government measures and also taking away the seasonal factors from Lunar New Year as well.
We're also seeing the retaliatory tariffs when it comes to US origin farm goods kick off today.
Yes, China is now imposing retaliatory tariffs on Canada, 100% on rapeseed oil and pea products, 25% on pork and other seafood products. That will kick off on March 20th. And this is in retaliation for the 100% tariffs that Canada has imposed on Chinese goods, on Chinese EVs, 25% on steel and aluminium. And the timing of this is interesting because China had launched this probe into Canadian rapeseed around October. The results are out now in March, just as Canada is preparing to review that free trade agreement with the US, just as Canada has been under pressure from the US to match those tariffs on Chinese products. So it's like a warning shot to Canada not to impose more tariffs on China, because these tariffs, they're pretty much like for like 100% and 25%, pretty proportional to the tariff rates that Canada has imposed on China, in stark contrast to how China has responded to the US, where the scale of the tariffs had been much less proportional, signaling that there is more space for renegotiation with the US, but less so with Canada.
All right, Bloomberg's China correspondent Min Min Lo there. More ahead on the Asia trade. This is Bloomberg.
Well, President Trump is expecting Ukrainian President Volodymyr Zelenskiy to eventually make a natural resources deal with the US, while continuing to accuse him of being ungrateful for US support. Bloomberg's Michael Heath joins us now for the latest. He does seem to have the confidence that he thinks Zelenskiy will come around.
Yeah, well, I mean, and I guess there's some logic to that, in the sense that, you know, the US is so powerful and so important there, and Ukraine will need to be rebuilt. So obviously that situation that blew up in the Oval Office didn't do anyone any good. But, you know, there was a sort of a sense of a little bit of a setup of the Ukrainian president there too, just sort of to put him back in his place. But President Trump's, you know, suggestion that Ukraine's ungrateful, I think is really quite unfair, because the US has been very slow to come to the party in terms of supporting Ukraine. They didn't expect Ukraine that would survive this, and each time it's sort of been like, you know, sort of getting blood out of a stone to get to the next level of weapons, when it was reasonably clear that perhaps moving earlier and doing more might have stopped this much earlier as well. We might be in a much better position. So yeah, you know, in all things considered, I don't think that's particularly reasonable. But in the transactional approach of the Trump administration, it also makes a degree of sense that that's how he views things.
In terms of that transactional approach, what are the future of US sanctions on Russia?
Yeah, well, look, it looks like the US is prepared to put them on the table. Some winding back of sanctions. There's talk on the oil cap that they had, just to try and reduce the amount of revenue that Russia has. It's probably not the best move when you're negotiating with Russia, because oil is their lifeline. That's the bloodline of the economy. It doesn't produce anything else. That's where all the money comes from, and certainly for the leadership and the elite there. So yeah, I mean, look, that would please Russia, but what the US is getting in return is kind of sort of interesting for this. You know, over these suggestions that perhaps, you know, we could get some sort of truce or peace, or you know, lifting of sanctions. Russia unleashed a very heavy bombardment on Ukraine. It's trying to take back the area of Russia that Ukraine nabbed ahead of any negotiations. So you know, the sort of in the US doing this, US putting pressure on Zelenskiy, is just empowering Russia in many respects. We're seeing here too.
So much pressure on Europe at the moment, right? Elon Musk calling on the US to get out of NATO, and just kind of piling on. And of course, the EU is going to be watching the progress made this week very closely.
It definitely will. I mean, there's talks in Saudi Arabia between Ukrainian and US officials to sort of try to get things back on track, whether that's to do with this minerals deal or just sort of where we're at in terms of a potential peace process. But Europe will be watching closely. And an interesting thing Russia said, it was in any peace situation, it wouldn't accept any NATO forces on the ground. It would accept Chinese forces, which, you know, Ukraine is not going to have any part of. But Europe really has to deal itself back in here. Polls are showing that at least in France and Britain, people are prepared to support increased defence spending. They are coming to the party on that front. So Europe will be watching closely, and it has a big role to play here. I mean, there is a lot of pressure on it now, and I mean, you know, people like Musk, etc., they're unofficial in a way, but they do often you know, express the sentiment within the administration as well.
All right, Bloomberg's Michael Heath there. Let's get to some other stories we're following. A US negotiator says a new Gaza ceasefire deal is possible within weeks. Adambola told CNN the possible agreement could even see Israel recover all hostages held by Hamas. A 6-week truce expired earlier this month, with both sides divided on conditions for more suspension of hostilities. Israel has since halted its limited supply of electricity to the Gaza Strip in response to the crisis. The European Commission says there's no reason to de-risk the EU's relationship with the US despite changes under the Trump administration. President Ursula von der Leyen has led a shift in the bloc's relationship with China that she has described as de-risking but not decoupling from Beijing. But she told a conference in Brussels that a similar strategy is not needed towards Washington. Heidi.
Take a look, Paul. Of course, we've seen some pretty seismic moves when it comes to European risk assets, right? A lot of this has been the rally due to the sort of revival of defence spending prospects there. We did see in the previous session some of these tariff jitters start to come into play again. The luxury shares, in particular retail kind of oriented shares, being a big part of how we saw a 10-week winning streak being ended for European equities on Friday's session. But it does look like we're sort of back to gains. Euro Stoxx 50 futures up 0.5% there. We're also seeing some pretty good gains there early on when it comes to German DAX futures there, despite that sort of 0.5% decline that we saw in the Stoxx Europe 600 index. And some of those miners, industrials, luxury goods makers, really these sort of growth and tariff affected stocks were the biggest movers to the downside on Friday. Analysts, so despite seeing, of course, these near-term risks, see that re-rating in European equities as perhaps just getting started. Any pullback, a lot of them are seeing as just buying opportunities at the moment. So we have seen a lot of whipsaw action so far, Paul, but certainly still a lot of optimism when it comes to Europe.
Perhaps not a similar story for the US, however. Let's take a look at how futures are tracking. The US last week was the world's worst performing market in the middle of this trade and tariff upheaval. It was only a month ago that we had the S&P at record highs. Here we have futures, well, they started the day looking okay. Now they're off by more than 0.8%. NASDAQ futures now off by more than 1%. Dow futures also in negative territory. We've also seen yields starting to slip. The yield curve steepening. The market now betting on 3 Fed cuts this year. Concerns about growth are increasing. We did hear from President Trump, however. He was questioned about this over the weekend. He said the economy is in a period of transition. Also, the Fed Chair Jay Powell says, well, he's not feeling any pressure at the moment to move on rates. Heidi.
Oh, it's a period of transition, certainly, and of watchfulness when it comes to US allies, right, including here in Australia. We do have a big interview and a conversation that we'll touch on this a little bit later. We'll be speaking to the former Australian Prime Minister Malcolm Turnbull to talk about the geopolitical landscape, that alliance between the US and Australia and, of course, China, plus the upcoming federal election and how to navigate the broader global trade war under President Trump. 1:30 p.m. in Sydney is that conversation, 10:30 a.m. if you're watching in Hong Kong. We do have more ahead here in the Asia Trade. This is Bloomberg.
Let's take a look at how the yen is tracking at the moment. The trend line, well, I guess you'd say stronger right now. It's been whipsawing around a little bit this morning, but we did get some data on wages a little bit earlier. Base pay rising 3.1% in January. That's the biggest advance that we've seen since October 1992. So that's something of a boost for the BOJ's policy normalisation intentions. We also saw a slight decline, however, in real wages earned, but the overall story in terms of wage growth fairly positive as the Shunto wage negotiations are underway in Japan. Heidi.
Yeah, clearing sort of a better path there when it comes to the Bank of Japan. But take a look at how we're tracking at the start of this week. It does look like a fairly sort of tepid open, if you will. We are seeing some modest gains here in Australia, about 0.2% there, but broad declines are being seen when it comes to the Nikkei 225, as well as trading the Kospi also looking pretty wan. Lots of concerns over US economic growth. growth. President Trump wants to call this as a period of transition and sort of not really acknowledging the potential for downside, but there have been a few recession calls, or sort of that probability certainly is being shifted by a lot of modelling at the moment. China is also providing its own sort of economic woes amidst this ongoing trade war and some of the retaliatory tariffs that are kicking off against both the US and Canada as well. But that inflation level dipping below zero for the first time in a year certainly continues to show the pressure when it comes to Chinese economic weakness. This, of course, at a time when we're seeing strength when it comes to Chinese equities. That stark outperformance between Chinese equities and what we're seeing when it comes to US equities just continues to widen, and certainly there's plenty of people that remain still very bullish on the stock market picture, at least for China at this point. A lot of that, of course, coming down to that private sector revival, the tech revival, the enthusiasm over DeepSeek as well. When it comes to the Kospi, we are just sort of oscillating between very mild gains and losses at this point, about 0.1% higher. At the moment, some weakness though trading in some of the tech-heavy names, the Kosdaq, for example. We saw really NASDAQ 100 futures sinking and contracts for the S&P 500 also sinking quite significantly in the early part of Asian hours today.
Let's take a look at how we're tracking in the commodity space as well. We've got the iron ore price at the moment just holding on above $100 per tonne. We've got Fortescue Metals here in Australia weaker by 1.8% thereabouts. Of course, Fortescue is a pure play iron ore miner, so something of a proxy for that trade. A bit of weakness across the commodities complex though. We've got copper declining by 1.25%. New York crude slipping as well, 66.78 a barrel. Ongoing concerns about the massive increase that we're seeing in production there, Haidi.
Yeah, and ongoing concerns, of course, when it comes to the trade and the tariff element, both on supply and demand, right? And agri traders are certainly watching out for potential cancellations on crop contracts amid ongoing trade uncertainty. Over 11 million metric tons of grains have already been sold, but not yet shipped to Mexico, Canada and China. The biggest concern for traders is that Mexico, the top buyer of US corn, will drop some of its 7.6 million tons of contracted cargo. China has 1.4 million tonnes of outstanding soybean sales, while Canada has a small amount of unshipped grains. Agri-products were also caught in the crosshairs of the US-China trade war during Trump's first term. Take a look at how we're trading when it comes to some of these agricultural and soft commodities. And of course, the big story is really the tariff set by Beijing when it comes to Canada. We saw the likes of canola futures, for example, sinking by the exchange limit after those tariffs were imposed on rapeseed oil and meal, as well these 100% import tariffs on those products, as well as levies on pork, some seafood products, not to mention the retaliatory tariffs that are due to take effect when it comes to some US goods there as well. Well, joining us now is Arlan Suderman, who's a Chief Commodities Economist at StoneX. Arlan, really great to have you with us. So we've kind of set up just how difficult the external environment is in this space right now. How do you sort of characterise the challenge in being able to forecast or model accurately levels of supply and demand?
Yeah, it's a real challenge, that's for sure, because the headlines are changing constantly and on the hour, it almost seems. And President Trump likes to keep people guessing. That's a negotiating tool he has. He wants to keep people in the dark and maximize the leverage he has, being the only one in the room who knows what he intends to do. You mentioned the soybeans that China has on the books. About 400,000 metric tons of that is already on the water. So it's about 1 million metric tons at risk of being canceled. They could roll that. I do expect to see some cancellations by China to send a message. It could be a few cargoes. It could be more. I don't think it significantly changes the balance sheet. Overall, China has moved to buying their soybeans from South America at this time of year anyway because they're cheaper. The big problem is Mexico. And Mexico buys about 1 billion bushels per year of corn from the United States. They can get they're our top pork importer as well, in addition to a large quantity of soybeans, soy meal, wheat. It goes on and on. We simply cannot afford to lose Mexico. But I think when it comes to Mexico, President Trump set the tariff high enough that he knows they can't afford it. They can't afford to retaliate by matching the tariffs either, because that would cause tremendous food inflation. They can find those commodities at other locations, but it would cost them quite a bit more in freight as well. And so either way, it's a no-win for Mexico. They're going to have to come to an agreement with President Trump. I think they will. Canada's another story. I think Canada will eventually, and finally they have a new leader now, and I think they'll be able to do business. But Trump keeps moving the goalposts as well on them, and that's creating a lot of fear in the commodity world until we actually do get an agreement.
You know, you talk about the inflationary pressures when it comes to food price, price and that basket. We know how the consumer is feeling at the moment when it comes to price pressures within the US. How are farmers and agricultural workers feeling, particularly with the implications of, immigration reforms and the impact on the labour market? Is it much less clear, the benefit there?
Very much in a little bit more confusion. Ironically, the agricultural sector, the rural parts of America, is where President Trump's strongest support base is. If you talk to people in those areas, they're very nervous. They want to see some relief soon, but they're still standing behind President Trump. So I think we will see China, we'll see other countries direct their retaliation toward that support base as much as they feel that they can. But at the same time, in doing so, a country like Mexico will take a direct hit on food inflation, which it can hardly afford to do. Like I said, China has alternative markets right now that are cheaper in going to South America, and it will be doing so. The next 6 to 8 months, we wouldn't see much agricultural trade go to China anyway. So two totally different stories between Mexico and China right now and how they're going to be handled. So I think it'll be quite some time before we have an agreement with China.
Yeah, you mentioned a moment ago that the only person who knows what President Trump is going to do is probably President Trump. So with that in mind, how enduring do you anticipate these tariffs against Canada and Mexico to actually be? I mean, do you anticipate some sort of agreement to then target China more effectively?
I do expect an agreement. When President Trump was reelected, we saw President Trump and President Xi Jinping moving towards each other in relationship, and I thought maybe this agreement will happen quicker than what I first thought. But now President Xi Jinping seems to be really digging in his heels and standing firm against President Trump. I think he feels like, and this has coincided with their 2 sessions policy meeting, I think he feels like their economy is stable enough that they'll be able to withstand this trade war at this time. I'm not sure that that's right. I disagree with that. I think eventually he's going to feel the economic pain of this and need to come to an agreement. I do think that there will be an agreement, but I think it'll be 6 to 12 months before we have an agreement between China and the United States.
Well, in the meantime, China is targeting other trade partners as well, including Canada, Canadian canola oil, seafood, pork products as well. How easily can Canadian producers find other markets for their products?
There's other markets. Certainly that's going to hurt. It'd be ignorant to say, or naive of me to say that it won't hurt Canada, but they also can't afford to lose the United States trade. And I think you keyed on something there. As I look at all of this, I believe that, yes, President Trump wants to stop the flow of fentanyl in the United States, but I see too many other things that he's doing here that indicate to me that China is the bottom line in everything. He's trying to contain China, and he is leveraging Mexico and Canada in that effort. And even what we're seeing happen in Ukraine right now in the Black Sea, it's all about containing China. And I think that's his number one objective beyond the fentanyl. It bothers him that we lost 77,000 people per year to fentanyl. So that bothers him. But beyond that, he's trying to contain China, and everything here is about leveraging that. I think President Sheinbaum of Mexico has done an excellent job of working with President Trump. And we've seen her be talking about things that she's going to do to contain China. Matching the tariffs is what she's considering, some other steps as well. And that tells me that her conversations with President Trump, that's what's coming up. And I think now that we have a new leader in Canada, I anticipate that's going to come up in discussions there as well. And I believe that if we had an agreement with Canada and Mexico to do what President Trump would like in trying to contain China, that we'd quickly see those tariffs back off. But over the weekend, Trump was talking higher tariffs possible he's trying to maximize the pressure now.
All right, Arlan Suderman, Chief Commodities Economist at StoneX. Thanks so much for your insights today. Let's get back to one of the stories dominating headlines here in Australia. Star Entertainment, the casino operator, has confirmed it's received a non-binding proposal from Bally's. Star's in serious trouble. It's running out of cash. It's trying to shore up its finances. It's been struggling with the financial crimes regulator. It's been unable to file its annual results, and shares are suspended at the moment. So enter Bally's, offering $157 million cash injection that will provide a capital raise of about, or at least 250 million Australian dollars, pursuant to which Star would then issue convertible notes, and those could be convertible into at least half of Star's fully diluted ordinary shares. So Star lives to fight another day. The story continues to unfold. More ahead on the Asia trade. This is Bloomberg.
China consumer prices fell in February for the first time in 13 months, suggesting that deflationary pressures continue to weigh on the economy. Let's take a look at how traders are digesting the data. Catherine Nye, who leads our Asia stocks team, joins us now. So, Catherine, at the time when we're seeing the significant outperformance continue when it comes to Chinese equities, right? We were just looking at that performance gap compared to US equities continuing to widen.
I mean, absolutely. It's such an interesting time, this report, given we're still in the middle of NPC right now. I mean, we've got a couple more days. And with the National People's Congress, what we saw last week was just a lot of promises to, reinvigorate this economy. And so far, I mean, even before this report came out, people have really believed that, held on to that. And we saw last week with the Hang Seng China Enterprises Index and the Hang Seng Tech Index, hitting 2022 and 2021 highs respectively. I mean, there is a lot of momentum and excitement about the way that the market and the economy is moving, and so this is going to be maybe take a little bit of excitement and froth off, to skim off the top, most likely. But again, I think a lot of people had expected, largely expected that the sort of road to reflation was not going to be so smooth, right? It was going to be a little bumpy. So I think this is sort of well within some of that expectation, but of course it's going to be a small slight setback, especially after euphoria from last week.
We've seen Chinese mega cap tech stocks performing pretty strongly. How long can this trend continue?
That is the $1 billion question. Last week we saw a lot of top political support talking about AI, wanting to develop, their own sort of better models, supporting the industry, trying to find new winners. There's just been a lot of excitement in this space. I mean, this is the rally. This is the Chinese tech mega cap rally that never was in 2024 when all the other global peers sort of saw that, and so they're really kind of taking their, taking advantage of this rally. I mean, there's still, you have to look at sort of the valuations right now. If you're looking for Hang Seng Tech, they're still sort of well below their 2021 highs. These are still really, really cheap kind of companies here. Even Alibaba, given the 70-80% year-to-date gains, I mean, it's still sort of well below its valuations from its sort of recent peak. And so there's, people are saying this is still a cheap sector to get into. They're still very interested, and there's still so much potential that they don't really know. But I think that, given this rally, investors are now kind of saying, where are people actually going to be, finding the pockets that are still undervalued. I think there's still kind of questions about monetization, whether this is really going to help their bottom line. Right now, everything is an introduction of a new AI tool and a stock rallies. This is kind of like a can't lose sort of mentality. But I think going forward, people are starting to say, hey, wait a second, let me figure out where these benefits, these new models are actually going to help margins, and they're going to be a little bit more selective.
All right, Bloomberg Asia stocks team leader Catherine Nye there. Let's stay in China. There's a new AI tool named Manus that some are calling another DeepSeek moment.
While other AI stops at generating ideas, Manus delivers results. We see it as the next paradigm of human-machine collaboration and potentially a glimpse into AGI.
Well, let's get some more with our tech reporter, Annabelle Drulers. So, Belle, who's behind Manus? What can it do? Why is it causing such a stir?
Yeah, it really has really sparked a lot of interest. It's only been released just in the last few days, and it's actually still very limited as well because it's in beta phase, which means that it's still testing, essentially. There could be a couple of different glitches, and it's also invitation only. But what we know so far is that Manus promotes itself as a general AI agent. So it's important to make the distinction between what Manus is proposing versus what we would typically know as an AI agent, a chatbot, because chatbots are really human-led. You put in the text prompt, it delivers you the result. This is taking it to a different level here. So it's essentially where the AI exhibits more autonomous capabilities. It's able to make decisions based on the information available to it. So they have lots of different test cases that they use on their website, but things like screening multiple job applicants, analysing financial statements, even proposing where you should live based on your requirements, including salary and school needs, for instance. So this is agentic AI. And stepping back just to look at agentic AI in total, this is really a theme that we were hearing would be a key one to watch in AI over 2025. And so this is also why we're seeing so much interest in it, not least as well also where Manus has been developed, and that's in China. And so again, it points to this ongoing competition between the US and China in developing the lead in AI, and especially when Manus is saying it can perform or outperform OpenAI's own advanced AI agent, Deep Research.
And the excitement and potential of agentic AI or AI with agency is that it removes a lot of limitations, right? But there are, at this point, still a lot of limitations when it comes to Manus.
Yeah, it's essentially, as you say, it's trying to create that I'm not going to say, well, ease of doing business. It basically wants to make your life easier by giving you that agent or that personal assistant who can execute tasks for you. The limitations, I think, mostly for Manus for now do relate still back to being in beta phase. As I said, it's invitation only at this point. Yes, you can submit a request on the website for a link and with a reason, and you can join a Discord channel, for instance, to get the latest updates, and they're also putting invitation codes in there, and it's got 150,000 followers. So again, it points to all of that enthusiasm for Manus at this stage, but there's a lot that we still don't know about it. We also don't know exactly how it's being developed, so there's other models that could possibly be underpinning it. Some are saying, for instance, Anthropic's Claude or Alibaba's QWen, and there's a lot of people that have pointed out the glitches, like Manus crashing, giving incorrect information. As I said, though, it is still in beta phase.
Annabelle Drulers there. I'll be talking more AI ahead in our exclusive interview with the Alibaba.com president, Guo Zhang. You can catch that on Tuesday at 7 a.m. in Hong Kong, 7 p.m. if you're watching in New York. This is Bloomberg. Well, India's most famous bridal wear designer, Sabyasachi Mukherjee, says big weddings are going out of style. He says modern brides are now looking for more low-key designs. Mukherjee tells Bloomberg how he's pivoting his business model from bridal wear to authentic luxury pieces.
You know, luxury businesses in their inception years are really valued on promise. Sabya might be a very irrelevant brand in terms of its revenue, but I think it is the most important brand in the country in terms of its reverence and in terms of its positioning and its opportunities. My father asked me when I was planning to be a designer that, how far will this go? Because he wanted me to be a doctor and I didn't. And I told him, mark my words, I'm going to become India's biggest designer in the next 15 to 20 years. And then I'm going to build on from there. I'm going to become one of the biggest in the world. And I still maintain it. I'll tell you the reason why I say this with so much authority. Because the opportunity is in being Indian itself. Because, you know, when I look at luxury today, worldwide it's failing. Because you're appropriating products from different parts of the world. Because you see, luxury really, you know, when you look at luxury brands, the real premise of luxury brands is authenticity, provenance, and culture. Mm. Where else in the world can you find something that is more stronger than what India has to offer? You know, for a long time, whatever we had was appropriated by the West. But today, with a more sensible, discerning, globally connected audience, they are going to buy luxury products from companies who have their provenance right. You're not going to buy a kimono from a French company, you're going to buy it from a Japanese company. So when luxury becomes about craft and handmade, I think India is going to start, I won't even say breaking the glass ceiling, because we never needed to break the glass ceiling, but India is going to become the biggest in the business. And I want to ride that wave.
But I understand you're reconsidering some of this, that at this stage in your 25-year journey, you might be reviewing how core wedding wear is to your business. You might be considering pivoting away from this. Have I got that right?
Absolutely. I think the wedding industry in India is, as we know of it today, is breathing its last. There were very big weddings that happened in the country, and people said it's going to revolutionize the way Indians see weddings, but I think that will not be the case at all. When I look at this country, I see a plane full of people just hopping from weddings to weddings to weddings to weddings, and I have to ask myself a question: when do these people work? And if you look at the new generation of Indians, they don't have that privilege. You know, when you start working very hard for your money, irrespective of how rich you are, you're also conscious about consumption. When you become conscious about consumption, weddings as we know today, which at one point of time was the domain of the idle rich, is completely going to change.
And that's it from the Asia Trade. This is Bloomberg.